Welcome to the daily update, and this is currently take 5 of this video. I've been having a lot of trouble with the microphone that I had been using, and so I'm trying a different setup to see if things sound any better. Unfortunately, I can't really test this out until I finish the recording and then go back and listen to it. So we'll see if anybody actually gets to hear this or not. But I'm going to go over the action in the market for Tuesday, February 15th, and then see how things look for Wednesday, February 16th. And it was a pretty positive day. We had a pretty strong up move in the S&P, but one day does not a trend make. So we'll have to just look at things and then see how they look moving forward from here. So to recap things, we did gap higher at the open. We went right up to R2, which was at about the 44.57 level. And we pretty much danced along that line for the rest of the day with sideways action. We just drifted throughout the day. And then we saw a little bit of an up move going into the close. Then we closed just slightly off the high. So we were up 1.58% overall. One thing to be aware of is that volume was slightly below average. On a good solid up day, we want to see a real conviction behind that. There were certain areas that saw good volume, but overall inside the S&P, we were below average. Well, with the uptick that we saw in things on Tuesday, that switched all of our technicals back to being mixed. After Monday, I had been more negative. As things moved up on Tuesday, we're not positive, but we're back into a more mixed environment. And I'll show you what I mean with the different charts. We still have lots of earnings reports that have been coming out and continue to come out. The real fixation now is on inflation and interest rates. And then there's some real geopolitical concerns right now, specifically between Russia and Ukraine. The markets really had every reason to continue lower on Tuesday. The PPI, the Producer Price Index, it came out on Tuesday and was much stronger than expected. Bonds reacted to that by going lower with interest rates higher, which lately has sent stocks going lower. But stocks kept their gains overnight from the futures market and then saw that bleed through into the daily session. So what can we take away from the session on Tuesday? That short and intermediate term breakout, yeah, it's failed, but with the bounce on Tuesday, it's still on the table ever so slightly. Now, if we go down from here, I'll probably take that off. But for right now, it's still in the background, lingering. And I'll show you what I mean as I go through the charts. Beware of capitulation. We had been looking for things to possibly break to the upside, and that hasn't worked. And so a lot of times people will just give up and say, I'm going to go ahead and go short. Well, over the weekend, I watched a lot of videos that made the assumption it's very clear we're going lower from here. Well, rarely are things very obvious in the stock market. Just about the time when you have it figured out is when something comes flying out of left field that you weren't aware of, and it throws your whole scenario into question. So we have to really beware of one-day-itis. We had a good solid up day, but we're right back in price ranges that we've been in before. Things have improved a little bit, but it doesn't necessarily mean that everything has switched. At this point, we have to look at the bigger picture to get a better context of what's going on. There is a potential de-escalation of the whole Russia-Ukraine situation, but the reports that I've read haven't really confirmed that. And there's also been some reports that I've read that suggest that if something's going to happen, it may be on Wednesday. However, with Tuesday's action, we did regain some moving averages. And as I stated earlier, the PPI did come in much stronger than expected. And if stocks had reacted to the PPI this week, the way they reacted to the CPI last week, we would have just tanked. But that's when you try to apply common sense logic to the stock market. It's not so common. You have to just look at what you're seeing on many different charts to reach a conclusion, and then say, okay, this is what I think the probability is, but if it doesn't happen, I'm looking at things for what if they go sideways? What if they go in the opposite direction of what I thought? You have to play all three scenarios at the same time. However, on a longer term basis and on a big picture basis, we are overvalued and have been overvalued. And at some point that'll be dealt with. But right now we're just looking at the day-to-day action. Our trend condition, which had been strengthening after Monday and looking to go down, well, with the up day, it's weakening again, and our bias has now switched over to positive, and our momentum, which had been shifting more negative, has now gone back into the mixed land of things. So let's look at the day's session. As far as sentiment, we're not getting any extreme readings of fear or greed at this point. And with the VIX, because we saw an update, we saw the VIX really go down, both on the closing basis chart and on the bar chart. And we closed right near the low because we closed near the high for the S&P 500. The VIX of the VIX also declined. It still shows that there's a lot of fear in the market, but there's less fear on Tuesday than there was after Monday. As far as our different sectors, technology had a good, strong day. It was up 2.6% as a sector. However, at the bottom, we saw oil prices really fall back, and the whole sector was down over 1% for energy. One thing that's interesting, if we look at the next chart, energy is still doing well since the all-time highs, but you'll notice if you've been watching these videos, real estate has now moved into the least well-performing sector of all. It's down almost 5%. Discretionary, which had a pretty good day on Tuesday, it's jumped up one and been replaced by real estate. And it may be that housing prices have gone up too far, too fast, and you're getting to the point where people can't afford them anymore. As far as inflation, the BDI is just not telling us much right now. But when we're talking about the Fed, this is what it looked like right before the CPI came out last week. We were at about almost a 95% chance that the Fed was going to raise interest rates anywhere from 0.5 to 0.75% at the March meeting. After Tuesday's action, we're now seeing this more even. And this kind of goes counterintuitive. If inflation is a big problem, and if the Fed needs to jump in and do something, which they didn't do after Monday's closed meeting, why are we going back to a more mixed environment here? Shouldn't they be getting in sooner rather than later? Shouldn't they be raising interest rates higher rather than more split between 0.25% and 0.5%? So this is another battle that we see going on. Pay attention to the bond market, though. The bond market participants tend to be very educated and very knowledgeable and very experienced. And so we want to watch what they're doing, even if it goes against what our logic might tell us. As far as our technical alerts, the Nasdaq had a good day. First, we went above 13.8, then 13.9, 14,000, then finally above 14.1. The cyclicals, which is more of a value play, it crossed above 50 as far as the bullish percent index. And then oil, which had been doing quite well, it dropped down below 95. And the utilities, which had been doing okay, they're kind of going more hand in hand with interest rates, they were showing an extreme positive reading. Well, now they've dropped below 70 and have given an official overbought reading. As far as our intraday look, we gapped up right at the open. The futures were up strong during the night. We retained that strength, shot right up to R2, and then just danced along this line, saw a little bit of buying coming in at the close, and closed just a tiny bit off of the high on Tuesday. And then looking at the bar chart, we still have some room for improvements if they're going to happen, where we did have an up bar, but we still are below the pivot, and we still have some short-term resistance overhead, which could be playing into the double top scenario. If we go back up a little bit You may also be starting to see a potential head and shoulders topping pattern. So those are just things that we're going to watch as things move forward. We are currently only down, I say only, we're in just normal pullback territory, 6.79%. We don't really start to get too excited about this until we get down over 10% from recent highs. In this case, it was an all-time high. So you have your doom and gloomers out there that are saying, end of the world, everything's over, it's time to jump ship. Well, we've only fallen now 6.79% since the all-time high. Are things going straight up or straight down? No. And that's what's causing a lot of confusion. We're just bouncing around like bumper cars right now. Growth saw an advance on Tuesday where value saw a decline. And then where we compare the two indexes together, growth is still showing some weakness, but it did have a blip up on Tuesday. And if you remember back in early 2021, we went through this battle before only to finally break back out above this. Is that what's going to happen this time? Well, we weren't really in an interest rate rising environment a year ago where we are in that kind of an environment. Inflation hadn't really reared its head yet a year ago, where now it is. So no, the scenarios that we're looking at are different, but we'll have to see. Is the market's going to take what's happening as the glass half empty or the glass half full? The Nasdaq 100 had a good day on Tuesday, so it actually outperformed the S&P 500. As far as our trend, we're just bouncing around. If we have an up day, the trend goes back to neutral. If we have a down day, the trend is suggesting it's getting stronger because the red line is above the green line. What would be nice is if this ADX right now was to drop below 20, that would give us more confidence if we wanted to do sideways strategies, maybe some credit spreads, maybe some covered call writing and things like that. But because the ADX is still in trend territory overall, at least in my interpretation, this makes getting into some kind of a sideways strategy a little bit risky, at least for my taste, unless you're looking much further out and you can set your credits farther apart from each other where they're not in danger of getting hit, at least in the short term. Then we're also looking at the mass index. This crossed above 27. We're waiting to see what will happen once this indicator comes back down to 26.5. The decision point scorecard has not changed on their trend models. They're neutral, short and intermediate term, with the long-term trend still up. The PMO signals, which had switched over on Monday, continue to be negative, even though the PMO is trying ever so slightly to improve. Intermediate term, we're down, but long term, we remain positive. As far as our breadth, we did see, based on price and volume, a good healthy day. So we saw this line turn up slightly based on price. We're still showing a negative divergence based on volume. Our advanced decline ratio, it was up on Tuesday, but it continues to be below 0 overall. New highs, new lows. We saw some new highs, but the trend is down with both of these lines that we use to measure the overall trend. But our advancing versus accumulation, accumulation versus distribution, we're above with the blue line turning up, and we're above the red line. So we're getting a bit of a mixed picture between the new highs and new lows and what's happening internally. As far as our short-term indicators, we regained the 20 period because it moves a lot faster. So that's somewhat positive. And we closed just at about the level for the simple 20 period moving average. Our moving average studies, 20, 50, and 200, both turned positive. Then our moving average lines here that looks like a jumble of spaghetti right now, we were able to get back above both of the 200-day moving averages, both the simple and the exponential. The MACD, which had looked like it was going to roll over negative, turned up ever so slightly. But our STO, which sometimes there can be a delay in how this is calculated, it continues to decline based on price and volume. This may get picked up after Wednesday's session, the advance that we saw. The McClellan oscillator, even though it was up for the day, it continues to be below zero, which means the summation index is also declining. Our very touchy indicators, the Stochc RSI, because we had an up day, this went up. And the Williams %R also crossed back above 50 and is slightly more positive right now. The force index, even though it's overall negative, did come up slightly. It closed right about here where you can see my cursor. The boom indicator, after showing an extreme negative reading, has gone back more into neutral territory. We're not getting too far away from any kind of a moving average right now. Intermediate term, with our 50-period moving average, we are below and have some work to do if we're going to regain that. I still have the 100-period moving average here, and both of these, especially the green line, it's going sideways. We have a lot of work to do if we want to get back above this pivot level and eventually break back above the both 100-period moving averages. The PMO, it's trying to cross back positive, but if we have a down day on Wednesday, this is probably going to continue negative. Based on price and volume, they're looking more negative right now. Our other PMO study, those that are rising went up because we had an up day, but those that are giving buy signals is flat to negative. Those that are above zero is still declining to a little bit flat. The BPI, even though we had an up day, continued to show more sell signals. Our moving average rainbow, we continue to dance inside the rainbow currently. Stochastic, short-term positive, intermediate and long-term are still looking more negative. The summation index based on price and volume continue to be negative. And then our different momentum oscillators, intermediate term, the slope is still looking good, but our other oscillator is rolling over. Longer term, we're looking okay, but could be weakening. Short term, we're crossing a little bit negative on both of these, but they could be slowly turning around. So we're getting a real mixed picture again. This shaken money flow, after being negative with the up day, it went back and is having a green histogram now. The Pring bottom fissure, which generated a signal last week, we're still waiting to see if something's going to happen, but it hasn't really happened yet. The vortex, because we had an up day, the green line ticked up and the red line ticked down. As far as our trading systems, the elder system with the up days back to neutral with the blue line, where the SAR continues to be negative. Different charts, the Heiken Ashi chart is just about in the middle. This would be like a doji right here. It closed about where it opened. The Kegi chart really didn't change, but it's still negative overall because it's drawing red lines. The Renko chart has just sat in the same, with this same look for many days now. The 3-line break, though, still continues to be more negative. The equi-volume is really not telling us anything right now. Point and figure is not really telling us anything right now. We had the 3 zeros drawn after Monday. Nothing new was drawn after Tuesday. So nothing is really going to appear now unless we break down with more zeros or are able to break back up with more X's. The Fibonacci, which again can be pretty subjective. I just went from this low about a year ago up until the all-time high. We had fallen slightly below the 38.2 retracement. Well, we were able to regain that on Tuesday. Longer term, and this is what I mean by looking at the bigger picture. We can drill down very heavily into what we see on a real short-term basis and lose the overall context sometimes, where, yeah, we're down to this red line, but this red line is still going up, and now we're back slightly above this red line. And if we look at the logarithmic chart, we're kind of seeing the same thing. Yeah, there's been some damage done. We might see some weakening, but still, if you really look at this going all the way back to 1980, would you be freaked out right now? Probably not. But that doesn't mean that we just rest back on our laurels and not do anything. The special K is pretty much going sideways, but on the longer term chart, it still seems to be turning down slightly. As far as the broad market, S&P, we're still more in a congested area. Mid caps also in the kind of the upper range of our sideways range. And small caps, which never really got out of the mess for the last couple of weeks, they're just at the upper end of what they've been battling already. The FANG stocks, even though they had a good solid day up almost 3.25%, they have a lot of work to do if they're going to cross back above these moving averages, and we want to see this turn up. So we just, yeah, it was a good day, but there's still a pretty negative picture for the big tech stocks right now. Also with ARK, it had a good day, up almost 5.5%, but it's been chopping a lot sideways as well. Industrials are right up to the pivot and right back up to the 200-day simple moving average right now. Small caps, they're a little bit above the pivot, but we've been dancing along this for some time now, and we still remain below the longer term moving average. Mid caps broke above the pivot. The moving averages are almost on top of each other right now. So a lot of work needs to be done for this picture to improve. The Nasdaq also had a great day, up over 2.5%, but we're still below the monthly pivot for February, and we're seeing the red line coming down to the green line. Nasdaq 100 also up almost 2.5%, but we have a lot of work to do just to get back to the pivot and really see price break back above. The Vixen, because we had an up day, we saw a decrease in fear, but there's still a lot of fear overall. We've been at these levels before. NYSE, we were able to get back above the pivot and regain the 200-day moving average. The S&P 100, even though we had a good solid day, it was pretty much flat. And if you want to see the big stocks in the S&P 500, if they really do well, you'll see this line go up much more than it did. So that's a bit of a warning sign. Wilshire, we still have some work to do just to get back to the pivot and to the 200-day moving average. Looking internationally, China is just kind of rolling around. Europe, emerging markets, Japan, and the US, they're trying to turn up. This is a slower indicator that's plotted right here. So it takes a lot more movement for these indicators to really move. Our all stocks index, we're still dancing around these moving averages. We broke below on Monday. We came back up, but we're still below the moving average overall. Broad market, the dollar came down just a little bit below 96. We've been seeing that lately. As the dollar goes up, stocks go down, and vice versa, where a lot of times they seem to act more independent of each other. And in the last time I checked, in the after hours, the dollar seems to be up and the S&P futures are slightly down. On our weekly chart, we are right about at the moving average. Oil, which got up over 95, has now dropped back down into the 92 range. Gold, which breakout. Okay, right now it looks like a fake out. And these poor moving averages, they don't know what to do. They cross over positive, then negative. Now they're trying to cross back over. So unless we get back above previous recent highs, it's kind of hard to say that gold is breaking out right now. Same thing with silver. It had a good day. Here was the open. We closed right near the high, but because of the gap lower, we ended up being down 2% overall. The CRB had about a 1.25% decline on Tuesday. Bitcoin's kind of bouncing around in the mid to upper 40s right now. sometimes more the mid, sometimes it goes a little bit higher. As far as bonds, this is what we're watching for. This is the 2-year spread. And this had really shot down after Monday. Well, it bounced back a little bit. And what we're watching for is, will it end up crossing below this red line? It hasn't yet, but this might signal, if this does cross below, that a recession may be coming in the future. The 3-month yield that I also track, it's not really helping us. It's going off in the opposite direction, but it has helped us in the past. Looking at the 10-year rate, we broke above this 50% retracement with the Fibonacci levels, and we're breaking above highs set back in 2019. So are we going to keep going up with interest rates now that we're up over 2% in the 10-year, or are we going to see things fall back a bit? Interest rates did go up overall, at least in longer term. In the longer term view, 30 was up, 10, 5, 2-year was flat, and we saw a bit of a decline in the 3-month interest rate. And then internationally, with the US still having the highest interest rate overall, bonds on a price basis continue to be in a pretty solid downtrend. The corporate bond index, it continues to fall with interest rates going up. And about the closest thing I could find, I went out to the Fed site to look at the seasoned AAA corporate bond yield, and you're getting around 3.5%, just maybe 3.3, 3.4. So if you were to get into a treasury bond, you're looking at 2% in the 10-year, or if you get into a corporate bond, you get a higher return, but you might be taking on more risk. That's risk versus reward. As our relative study, the only one I'm looking at right now is gold against the S&P 500. We could possibly see a breakout happening with the S&P going lower as gold tries to break out higher, but that came down a little bit on Tuesday. So what do we look for on Wednesday? The positive backdrop, it's still there. It could come back if we see follow through buying. If we have a down day on Wednesday, that positive backdrop could just vanish. We're still in the middle of earnings season. We're still seeing that battle between growth and value. We have a lot of economic reports coming out on Wednesday. Retail sales, a huge report. Industrial production and capacity utilization. That's what the Fed uses very heavily. At least Greenspan used to use that a lot to determine interest rates. We have a housing report coming out that could influence the real estate sector. And then the big one is at about 2 p.m. Eastern time, you're going to have the release of the FOMC meeting minutes. And they're going to try to read all the secret meaning into this, figure out what's going on. What do they really mean? What did different people inside the committee say? And that may have a real impact. Geopolitical events, I talked about Russia, Ukraine. We still have the Olympics, the Iran meetings, which I really haven't heard too much out of that. And then Canada, which seems to be having some real problems these days. That's also something that at least the US news media is fixated on right now. So what's our conclusion? We're back to mixed. Yeah, isn't this fun? The breakout that is appearing, it may be less likely that that will happen, but it's still possible if we get some follow through buying. On a short-term basis and intermediate-term basis, we're back to mixed. Our long-term bias remains positive, but still showing some weakness. And when I talk about that, one of the things is the valuation. We are just way overpriced as far as justifying current prices with valuation levels, but that'll get dealt with at some point in the future. The market isn't really worried about that too much right now. So thank you very much. I'll check the quality of this recording. I hope you have a very good Wednesday, and I will talk to you again after Wednesday's session.